Hi, I'm Keith Quinn, the Director of Investments for Shoemaker Financial with an economic update for March 2017. In this month's update, we'll touch on some of the recent economic news and hopefully we can give you some insight into what these developments could mean for us as long-term investors. Well, April is now in full swing and the first quarter of 2017 is now officially in the books. And it was a pretty good quarter. The Dow Jones Industrial Average gained 5.19%, while the S&P 500 did even better, gaining 6.07%. And the NASDAQ Composite had its best quarter since 2013, moving up 10.13%. However, most of these gains were in January and February, as the NASDAQ was the only one of the three indices to have an increase in March. In fact, after numerous record highs in February, March saw the S&P 500 flatten out, and the Dow actually gave back 0.72%. While the markets may have provided fewer record-setting headlines in March, we did pass a milestone in the economic recovery, the 8th anniversary of the Great Recession's lowest market day on March 9, 2009. And looking at a few of the data points shows just how far we've come since the 2009 lows. So first, let's consider unemployment. In March 2009, the unemployment rate was at 8.7%, and it actually reached 10% by October of that year. But the current unemployment rate is 4.5%, and that's less than half of the highest reading during the Great Recession. Next, GDP growth has also substantially improved. Remember that in March 2009, we learned that the economy had contracted by 6.3% in the fourth quarter of 2008, and that was the worst decline in 26 years. But last month, we received the final reading for fourth quarter 2016 GDP growth, and that showed the economy growing at 2.1%. And even though the pace of the recovery has been far slower than many people would prefer, the economy has grown almost every quarter since 2009. Now, another sign of our continuing economic recovery is the Federal Reserve's tightening monetary policy. Keep in mind, the Fed raises interest rates to keep the economy growing at a reasonable pace and to try and control inflation. But for a decade between 2006 and 2016, the Fed did not raise rates a single time. And in fact, they took the overnight lending rate from 5.25% in June of 2006 to 0% in December of 2008. Now jump forward to last month, and on March 15, 2017, the Fed announced just its third interest rate increase since 2008. But even with the recent hikes, the benchmark rate is still historically low as we slowly move back towards a more normalized interest rate policy. And if we look deeper at the most recent personal consumption expenditures data, which is a key inflation measure used by the Fed, we can see that it's climbed above the Fed's 2% target for the first time since 2012. And that leads some analysts to believe that we may see 2 or more interest rate hikes before the end of the year. But for now, anyone with a credit card debt, a home equity line of credit, or other liabilities with adjustable interest rates may see an increase in their payments coming pretty soon. However, keep in mind that rising interest rates indicate that the economy is growing stronger. So overall, 2017 is still off to a pretty good start, and we are continuing to see a variety of encouraging economic data. And all the encouraging data isn't just in the U.S. The recent French election in Europe resulted in a runoff on May 7th between the two leading candidates, centrist Emmanuel Macron and the far-right's Marine Le Pen. And that's pretty much the best-case scenario for the markets, as the markets would far prefer the more moderate Macron, and he has a strong lead in the polls over the anti-European Union Le Pen. Well, that's it for this month's update, and please remember that nothing we talk about here should be taken as a recommendation. And if you'd like some more guidance on approaching your financial needs or balancing your assets and liabilities in this current environment, always remember that we're here to help, so please don't hesitate to reach out to your advisor, or you can always give our office a call at 1-800-757-1059. Until next time, I'm Keith Quinn for Shoemaker Financial, wishing you continued peace and prosperity.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. This material represents an assessment of the market environment at a specific point in time and is not intended to be a forecast of future events or a guarantee of future results. The S&P 500 index is an unmanaged index generally representative of the U.S. stock market. It is not possible to invest directly in an index. Investments will fluctuate and, when redeemed, may be worth more or less than when originally invested. Past performance is not indicative of future results. This material has been provided through the research of Platinum Advisor. Keith Quinn is a registered representative and investment advisor representative of Securian Financial Services Incorporated, securities dealer member FINRA SIPC. Shoemaker Financial is independently owned and operated.